Artificial intelligence has become one of the biggest stories in the US stock market. Investors have poured enormous amounts of money into companies connected to AI infrastructure, semiconductors, cloud computing, data centers, and software. And the earnings story has been powerful. Reuters reported that S&P 500 companies saw aggregate second quarter earnings rise 52% year over year in 2026, with technology sector profits up 74%. Reuters. That is the kind of growth investors want to see. But there is another side to the story. When an industry becomes the center of investor attention, expectations can become extremely high, and high expectations create a risk. A company can report excellent earnings and still see its stock fall if investors expected something even better. That is one of the most important lessons for anyone watching AI stocks. Stock prices do not simply reflect whether a company is good, they reflect expectations about the future. Imagine a company earns $10 billion. That sounds incredible. But if investors expected $12 billion, the stock could fall. Now imagine another company earns $5 billion when investors expected only $3 billion. That stock could rise sharply. The market is constantly comparing reality with expectations. And AI companies are facing some of the highest expectations in the market. Another concern is the enormous amount of capital being spent on AI infrastructure. Data centers require power, they require chips, they require networking equipment, they require cooling, they require land, they require financing, and they require enormous amounts of money. That creates opportunities for companies selling the infrastructure. But it also raises a question: who ultimately pays for all of this investment? The answer depends on whether AI produces enough economic value to justify the spending. If businesses use AI to dramatically increase productivity, reduce costs, and create new revenue, the investment could prove extremely valuable. But if companies spend enormous amounts on infrastructure without generating enough returns, investors may eventually become more cautious. This is why AI is not simply a technology story. It is an earnings story. It is a capital spending story. It is an interest rate story. And it is a valuation story. The bond market is especially important here. Recent U.S. market weakness has occurred alongside rising Treasury yields. On August 20th, 2026, the 10-year Treasury yield approached 4.7%, while the 30-year yield reached about 5.24%, according to Barron's reporting. Barron's higher long-term yields can create pressure for companies that depend heavily on financing. They can also make investors reconsider how much they are willing to pay for future growth. That doesn't mean AI is finished. It doesn't mean technology stocks are automatically bad investments. It means investors need to separate the technology itself from the price being paid for exposure to that technology. Those are two different questions. AI can transform the economy, and a particular stock can still be overpriced. Both statements can be true. This is why diversification matters. If your entire financial future depends on one industry continuing to rise, you are taking a very different level of risk than someone who owns a diversified portfolio. And diversification does not mean avoiding technology. It means recognizing that no single theme is guaranteed to dominate forever. The market rotates, capital moves, leadership changes. Companies that appear unstoppable can eventually slow down. Companies that are ignored can suddenly become market leaders. That is normal. Another important factor is earnings quality. Investors should look beyond revenue growth. Ask how much profit the company is actually generating. Ask whether cash flow is improving. Ask how much the company is spending on capital expenditure. Ask whether debt is increasing. Ask whether margins are sustainable. And ask whether the company's growth depends on customers continuing to spend at an extraordinary pace. These questions matter even more when valuations are high. Recent reporting also highlighted concerns about the sustainability of some AI-related gains and the financing behind the enormous AI build-out. Reuters +1. That doesn't mean investors should panic. It means investors should remain realistic. The biggest mistake during a major market trend is assuming the trend can never end. Every major technology cycle eventually faces questions about profitability. The companies that survive are usually the ones that can turn technology into durable business economics. That is the real test for AI. Can AI increase productivity? Can it reduce costs? Can it create new products? Can it generate recurring revenue? Can companies earn more from AI than they spend building it? If the answer is yes, AI could remain a major economic force for years. But if spending dramatically outruns returns, investors may eventually demand evidence of profitability, and that's when the market can become much more selective. For American investors, the key lesson in 2026 is not to blindly love or hate AI. It is to understand what the market is pricing in. Strong technology does not guarantee a strong stock return. Strong earnings do not guarantee a rising share price. And a temporary market decline does not automatically mean the long-term story is broken. The best approach is to focus on fundamentals, diversification, time horizon, and risk. Don't let a viral headline convince you that you have to become rich quickly. And don't let a market correction convince you that every long-term investment is doomed. The AI story is still developing, the US economy is still adapting, and investors are still trying to determine how much today's enormous AI spending will ultimately be worth. That uncertainty is exactly why 2026 could become one of the most interesting years for US investors.